All right. Good morning, everybody. The wait continues, kind of. And we have weakness this morning in two of the large cap names, NVIDIA and Tesla, as a starting point. Tesla's got delivery numbers that are going to come in, and the consensus is that it's going to be light. Um, so we'll see. If they come in on a surprise and they're not light, that could change everything. We'll see. Hong Kong, green, but basically flat. The Dow down near 0.5%. S&P is down 0.5%. NASDAQ beyond that, but not quite 3/4. And then the Russell closer to 3/4 negative. Europe in the red. Japan in the red. I mean, everybody, right? Everybody's in the red except Hong Kong, and they're basically flat. That's a good starting point. We have POW in Portugal. Now, a couple ways to look at it, and I didn't dig into this because I really didn't expect it to be very much. Whenever you have a Fed speaker talking, you can go hunt, especially on the Federal Reserve website, and you can find out where they're speaking, if they're actually speaking live, because a lot of times they won't be, it'll just be a recording. You can see if there's going to be questions and if there's any prepared remarks. And a lot of times what you'll find out is it's a recording or it's a lunch at some event like Boy Scouts of America or something like that. And you just know there's not going to be anything that comes out that really shakes the dice. Having said that, anytime it is live, even if it's at some lunch somewhere, if the reporters are able to ask questions, then there's the chance for a screw up. I know it's a small chance, but it is a chance. And I've seen it happen where the speaker says something that is taken out of context. He says something that he wasn't meaning to say at this time, like he was trying to hold something back and he had been for a while and then, oops, let it out the door. Or just a reporter taking things completely out of context and running wild with it, or the algo grabbing a hold of a word that is said and moving markets with it. It happens. I've seen it happen. I've felt it happen in my accounts. So if they're live, you always want to be cognizant of when they're going to be speaking. If they're going to do Q&A, that's a big one. But if it's recorded and there's no questions and it's, especially in another country, it's probably not going to really do anything, right? Now, there's always that thing, right? Some of the big ones, are like Jackson Hole. That's a big one, where they're going to give prepared remarks that can move markets, that sort of thing. So you can always dig deeper. The job opening numbers, this is a week of employment numbers. We're going to be getting them all week, but the big number is on Friday. So while I would never say that this jobs data is irrelevant, it's not, but it's not the big one that we're all looking for. Non-farm payrolls on Friday, that's the big one, right? That's the one that really moves the market. So at 10 a.m., we are going to get some jobs data. And if you look at what the previous number was versus the forecast estimate, it seems that job openings are dropping a little bit. That goes to the heart of what the Fed has been trying to do, right? Remember, they got a dual mandate. They would never say they're trying to kill jobs, but they do like to see that the job openings are down in the current phase of their efforts. They want to see that they're being rewarded for their struggle. We're going to get a lot of auto data today, not just Tesla, but Tesla's the big one. There was, if you were watching the watch lists yesterday, you'd notice there was a lot of car companies that were popping up in the burner. Ford, GM, XPEV, Tesla, they just kept popping up throughout the day, getting flows. European Central Bank Christine Lagarde, that's the female version of Powell, the female European version of Powell. As far as I could tell, she seems twice as intelligent and talks half as much. There's probably something to that. Jolts numbers. If this one confuses you, always think of it as the take this job and shove it numbers. If you think back to 2007, 2008, jobs were scarce. It was hard to find a job. So if you had a reasonably decent job, you hung on to it and you did everything you could to keep it because you were, concerned that if you lost the current job you had, you would have a really hard time finding a comparable job. And that's the JOLTS numbers. It ties right back into what we were just talking about with lower jobs out there, right? Now, if this number surprises in the other direction, we got to come back to, is good news good or is good news bad? And is bad news bad or is bad news good? The Fed is trying to slow down this hot market, this hot economy, or is what they say is a hot economy. They want to slow everything down, reduce hiring, everything. So they want to see bad news as a sign that what they're doing is working. The markets want to see these bad numbers to show that what the Fed is doing is working, because it implies that the Fed will have to cut sooner. So bad news is still good to the market. And until that dichotomy changes, we're not going to leave this rabbit hole race that we're in. So bad news is still good. The dollar just broke down. Oh, never mind. I have to zoom out a little bit. It's down a little, but I mean, it's just getting back below that 106. So 2-year stable. Nothing. Now, we did see a significant disconnect between the market and NVIDIA a week ago, maybe a week and a half. It all starts to blur together. The fear was that with NVIDIA carrying the market higher and higher and higher, once NVIDIA called timeout, took a break, digested, pulled back, that the market would too. We've seen a significant move back in NVIDIA, and the market did not match it. I think there was, what, a 1% decline in the NASDAQ at the most by the end of that day. So sure, it creates a weakness in the market, a pause from any sort of a rally, but the market did have a very nice disconnect between itself and NVIDIA. We'll see if that continues. Still, a weakness in a major Mag 7 name is going to dampen the market. And then, throw Tesla in there too. It all just starts to pile up, right? So Meta or Facebook pulled back significantly over the last few days. Google, Netflix, and of course, NVIDIA, it pulled back actually, what I was talking about a few days ago, a week and a half ago, whatever it was. And it's just been chopping inside that range since then. Closed at 124 yesterday. It's at 123. this morning. Uh, maybe a $1.40 difference. I mean, it's down a little bit, but not that much, not yet. Riding underneath the VWAP, we had a really nice balance in the market here. That finally broke down. Liquidity resides on the other side of the pivot. This is often called a draw. It's a draw and a raid. So the market goes into balance, lures everybody in. Think about longs and shorts all getting in here. Shorts would put their stops up here somewhere. Longs would have their stops down here somewhere. It draws in everybody because both sides can play this expecting that they're going to be right. Then we raid into that liquidity, gather a lot of liquidity up, and make our move. Now, it doesn't have to play out that way, but that's what a draw looks like. And then that's what a raid looks like. They raid that liquidity. We don't have an MDP today, but we did have one yesterday. MDP is a missed daily pivot. It's exactly what it sounds like. We did not hit the daily pivot yesterday. That's a trading strategy. It's not my strategy. I don't trade it, but I do use it for context and analysis. As a lot of strategies out there, I don't trade a lot of the strategies that I learn, but learning them just gives me another tool to analyze and understand the market better. The missed daily pivot is one of those. It was insightful to learn it. If you just Google missed daily pivots or search for it on YouTube, you'll find some videos on it. It just provides a little bit more depth of understanding of how markets react and respond around their pivot points. Since a market hits the pivot 80% of the time, the fact that it didn't hit that pivot kind of gives us a little bit of context. But on the day that it didn't hit it, it doesn't really matter to us. It's the next day. It's really where it comes into focus. It is worth noting that today's pivot and the entire channel is below yesterday's. So it's completely outside the range. They're not overlapping at all. Like back here, they were overlapping. The channels were touching. They're not touching over here. We did open above the pivot point, and now we've crossed through it. That will now make it a significant potential resistance if we were to try to make a rally back up. There's a cog line above this at 32 or 33. So just a few points higher. Consider that also an area of resistance, or at least a gravity point. We'll zone in on it. We'll pull to it. It's also worth considering where yesterday's point of control is at. It's not showing on this screen. We're going to get to it. But yesterday's point of control, if I was to hazard a guess, is going to be somewhere near the middle. But if we find a lot of volume near this low, that would be a high volume node that we're now interacting with. We'll find out, right? It would make sense just from looking at what we've got down here that we came down into a high volume node, that there was a lot of structure down here, which is why we revisited it and then we hung out there for as long as we did. We are breaking down through the S1. It's worth pointing out how that wasn't a perfect level of support. We didn't touch it and stop. We actually cut through it to the other side of the S1. But we held at that zone, struggling underneath VWAP as VWAP got tighter and tighter and tighter. And now we're finally breaking down and expanding away from VWAP again. As long as we're still above the S2, then we can still rally back up to the pivot point, either before the open or after. One of the things we want to see before the open is if we can get below that S2 level. Keep your eye on yesterday's low. It's a significant pivot point, but just keep in mind that this is a zone since it closed, these candles closed the way that they did. So all of this is considered a part of that pivot. An old trick that I was taught when it comes to doing technical analysis and marking out levels. Imagine you're drawing with a fat, dull crayon, not a sharp, skinny pencil. So when you go to mark a line, just imagine that price doesn't see your line, right? It doesn't care about your line. And to the tick measurements are worthless. You want to give price a zone or a range to deal with. And this is a good example of that. Now, I only marked the range to the low of the day, but if I was being fair, I would have marked it a little bit wider on each side of it, right? That would be more appropriate. All right, we are at the ADR levels. Generally speaking, if we get to an ADR level this early in the morning, we can go to the other side by the end of the day. The other side is at 55.60, basically. And right now we're at 55.06. So talking about a good run on the day, rallying all the way back up to yesterday's high, breaking out of yesterday's high and running 50% higher than that. Now I just swagged that 50. We can measure it and see I wasn't far off, right? I missed it by a tick. That's the beauty of using quant levels. If your pivot points line up with a pivot that came from an external source, it's an even more powerful pivot. That upper ADR level isn't just a math formula from the last 21 days. It's also yesterday's measured move of 50%. It's yet again just another reason to believe that that's going to be a significant level if we can get a breakout above yesterday's high. Keep in mind, there's a math statistic that goes to the futures for the ES and the NASDAQ. No matter how bullish, no matter how bearish, in the first 30 minutes of the regular trading session, meaning between 9:30 and 10, we can change direction at 50%. That's a coin toss. No matter how bullish we are when we get into the open between 9:30 and 10, even if we're ripping to the freaking moon, we can turn around and go the other direction within the first 30 minutes. A coin toss of 50%. That's a number that stuck with me over the years because it's just very eye-opening how there's no edge in the first 30 minutes. You know, we can buffer that a little bit by using, you know, the moo orders that are coming in at 9:20 and things like that, the market on open orders, MOO. We can use that and other things to kind of develop a better sense of how that first 30 minutes is going to go, but that's still a very powerful statistic. So sure, we're near the low of yesterday. It looks like we could break down out of yesterday's range, but no matter how bullish or bearish we are, the market can change direction in the first 30 minutes. We are setting up for a little bit of a double bottom, which is a bear trap. So it's worth talking this over. When I was first getting into trading, I was under the impression that when you had a low and price was coming back to that low, that it was supposed to stop at the same spot that it stopped last time. I was a firm believer in this. I would trade pivot points on the expectation that price was going to come down and bounce and hold that level. And that is what a good double bottom was supposed to be. That is absolutely not true. A double bottom is a bear trap. What bear is going to get in if price bounces right on the line? We gotta trick them, entice them like a trap is supposed to, right? You gotta lure them in. So you need it to break lower than the previous low and get down lower than that so that the bears actually get in, so that we can then trap them, squeeze them until they pop, and their buying adds to the buying, which adds to the really big push to the upside, and you get that exaggerated move back in the other direction. That's a really good double bottom. So if we don't hit the line at all, which is what we call front running, or if we bounce right on the line perfectly, then it's not a double bottom. What you have instead is an inverted cup. And then often what you'll get is the handle on that inverted cup, and then you will continue the move to the downside. Now, not always. There's always an example where it breaks the rules, it bounces right on the line perfectly, and it moves to the upside. Or they front run it, it never touches the line at all, and it bounces to the upside. So you're going to find those examples because price isn't perfect. It's a bunch of people arguing over price, right? So this is not um, an art project or a scientific experiment where everything's going to work perfectly. Real world, you will get bounces that run. But right now, this is not a double bottom yet. It's a potential double bottom. It won't be a double bottom until we trap those bears and squeeze them till they pop. So I put this Fibonacci on here and I added the 111. When we get a double bottom or a double top, and we're looking for price to break through the previous level, it only needs to go so far. If it goes too far, then there was no trap, the bears are in control, and we're headed to the downside. But how far is too far? And at what point should we expect price to turn around and go back the other direction? 111 works out really well for that. It's not perfect, but a lot of times you'll see price get into that zone. Remember what I said earlier about giving it a little range on each side. It's not supposed to touch the line perfectly and hold, but price will get into that zone and it'll stick or not. If it sticks, then it'll hold that area and come back the other way. Now, I drew it this way where we hold that area, but that's not really what you want to see. A good bear trap is that we get down into that spot and the trap springs shut and it immediately V-bottoms and just rips the other direction. Hard and fast, not giving those bears a chance to change their mind until they're really in pain up here. And then you get that wash of buying as the bears get out, which really fuel that bounce to the upside so you can get these exaggerated big candle moves. If it gets down to the 111 and it starts this choppy sideways stuff and then meanders up, I don't like that as much because it's giving them plenty of time to change their mind and get out. And then the only ones that are in there are buyers, no trapped sellers. If we get through that 111 and we get to the 1236, it's still not yet a move to the downside. We would have to get beyond the 1236. I've seen double bottoms that get down here. They tangle into the 1236. We get that sidewaysness and then it rallies back up. Okay, that's fine, right? It's okay. But we'd still rather have that V bottom, very responsive, aggressive, triggered trap. That would be better. If we do get to the 1236 and we get below it, and we just pause there and digest, the longer we digest at that level going sideways, the more likely it is we're just going to continue to go lower. So then you might see a retest of the 100 zone just from the idea of price, making a move, digesting, pulling back some before making a move. At this point in the day, I'm still not overly bearish because we have a really nice setup here for a reversal. It is worth noting that they are hedging this morning. This isn't my opinion. I don't think they're hedging. We know that they're hedging. This is fact, just like the sun comes up. It's a fact. This is not in question. It's not something to debate. I say that because I've had pushback from more than one person that says, you just think they're hedging, or how do we know they're hedging? We don't know for sure. In a lot of options trading, we have to say we're not sure, right? We don't know what the other side of the trade is. We don't know how much they're holding. We just don't know what their true intentions are. We can assume, but we never quite know for sure. When it comes to whether or not they are hedging in the futures in the morning in this situation, we know for a fact that they're hedging. Cheers. You can see that the NASDAQ is really trying to hold that 10-day moving average, which isn't going very well, starting to break down, but the 3 is still above the 10. On the ES, the 3 is still above the 10, but yeah, just barely. I mean, just it's there, right? 2 points. We're firmly below both. The NASDAQ is nowhere near yesterday's low yet. Yet the NASDAQ is down more than the ES. So structurally speaking, the NASDAQ has a lot more room to fall. Once it breaks that 19.9, it could easily go to 19.8. It's a nice 100-point move to get down to yesterday's low. But the ES is already at yesterday's low and has much less room to fall. Should be a halfback structure here on the NASDAQ. I missed this high here. Second. So you can see how we were holding that halfback range, and it wasn't perfect. We were holding that and the 10, so really nice support. Well, all of that is now really nice resistance. Now that we're through the halfback, we're still more motivated to go to 19.8. 10 years pulling back, which should help, but so far it's not. The dollar's pulling back, which should help. So far it's not. No intervention out of Japan. Gold retesting yesterday's Globex low. We'll see if that holds. All of this is saying be careful. There's a lot of things that aren't behaving correctly, and that just screams warnings. You know, it always frustrates me when these don't behave, and then traders reach out and say, hey, I thought you said it was supposed to do this. And they're not wrong. But there's just some times where these tools don't work. I can't explain why sometimes the dollar does what the dollar does, or the 10-year, and why the ES and the NASDAQ are not responding to it the way that they're supposed to, or the way that we would expect them to. The thing is, they just don't work sometimes. And what you have to do is just step back. Don't try to fiddle with them or adjust the settings or, read into any of it. Just recognize, hey, it's not working. So today, for an example, the 10-year making this move down, the dollar making this move down, and it's not affecting the NASDAQ and the S&P at all. I won't ignore them at this point, but I won't expect any move from either one of them to affect the markets at this point. We would need much more. And then I would start looking for key levels like 50% of yesterday's range to be broke on the dollar, or getting below the 10-day in the dollar index. That might actually affect the market. Same thing with the 10. Marking out yesterday's range from high to low, marking the midpoint, seeing the 10-year break below the half point of yesterday, or even getting below yesterday's low, right? Setting key levels on those two products as swag levels to get beyond, above or below, before we start to see any impact. Because what we're not seeing is a tick by tick move where the Dixie's going down and the ES is going up, or the 10-year going down and the ES going up, which is what we would like to see. That didn't go as deep as I would have wanted it to go for a really good bear trap. We had a nice reversal, to be sure, no argument there, but I would have wanted one more candle. But that is the 3-week moving average, tends to be structure. If I was going to try to trade this, then getting in when we break above the high of the lowest bar, that's a play. Or getting through this 50% mark, that's a play, right? You can You can do either one of those. I don't really like this reversal though, this move up. It should have gone a little bit deeper. If you can catch it on the wick, catch it on the wick back, try to get in right along that 50% mark if it lets you in. Otherwise, this is what we call, the swing low. And after a swing low, you expect all of these wicks on the run back up. So when the current bar candle closes and you get the new one that opens, rather than getting in as soon as the new bar opens, wait for the wick. Save yourself a couple of ticks of pain. But I don't like that reversal. For a bear trap, that was poorly executed. We do have a very small market maker move, and it seems like it is fading already. So whatever they were hedging, seems that they're already done with it. Keep your eye on it, 0.08. Just remember that number. Check back, in an hour or two. You can check if you have the indicator just by turning it on. I made it. It's in the Thinkorswim workbook. If you don't have it, you can always just go to today's options. The reason we have a market maker move is because the front options average IV is greater than the next series out. So we have 9.4 in front and 9.3 in back. You can come and look and see if the disparity between these two, which is only 0.10, if it gets bigger, then you'll know that the market maker move is increasing. You may not know the full size, but you can always just DM me and ask what the market maker move is. Doesn't bother me. I like it when people ask me questions and talk. I like 55.60 for the day. I know that seems odd at the moment, but we got to the ADR very early. And we're supposed to hold the range. And we've been holding this range really well. It's been kind of violent. We've had some upside tests. It wouldn't surprise me if we get a really long bottom side test, right? Really deep wick here, and then rally back up so that it looks a lot like this by the time the end of the day gets here. So we're just testing this low, this 5,500 zone. And even if we go all the way down to 5,500, we could still make it back up to 55.60 by the end of the day. Oh yeah, no problem. 10-day, 30-minute volume profile. I had mentioned yesterday that as long as we didn't break this low and go lower, then we would lose this volume here on the left, and that we would have a much narrower profile. Now we're talking this morning about breaking yesterday's low, getting down into 5,000, and that will keep the profile at this size. If we don't do that, then this will be the shape of the profile. And we expanded a little bit lower yesterday. It was going to have a low of about 55.11 cog line. Then yesterday happened, and now it's what, 5,500 or close to it. So we gave up another 11 points on this structure. We still have a classic D shape though. We still have the point of control overhead, and absolutely nothing is going to change that anytime soon. Nothing. So just get comfortable with that. It is over our head. We got to get through it and beyond it. There was a discrepancy in the options world. The SPX call wall rolled up, but the SPY call wall did not roll up. That's how our Monday started. And one of the things that I was looking for is, was the SPY call wall going to roll up, or would the SPX call wall roll back down? And so far as I can tell, the SPX call wall did not roll back down. It's still in its same spot. Now, the AM edition note came out right before I started, so I didn't get a chance to read it yet. but it is worth the read. Their insight on a day-to-day basis for the levels of the day and whether or not we should expand is fantastic. I don't know of any resource better for anticipating the kind of day we're going to have. If you're not reading that Spot Gamma Founders Report when I post it every day, you're doing a disservice to yourself. First, it's expensive, right? And you're not paying for it. I'm giving it to you. So I've had people say, well, I don't trade options and it just seems like a bunch of nerd talk. Maybe, but that means you didn't read down even just a little bit, because it does get to plain English and says things like, I don't think we're going to break yesterday's range. I mean, that how much more plain English can you get? So take 2 minutes out of your day and read that morning briefing. The AM, I mean, the PM is good. I wouldn't disparage it, but the AM is the sweet spot. We technically don't have a VPOC from yesterday because we opened and cut through it. It's already been touched. But as I've spoken about more than once, the textbooks don't even mention VPOC. The textbooks say you should mark this range every day. The value area high from yesterday, the value area low from yesterday, and the point of control from yesterday, and carry them forward into today's trading session. I don't do that. I've already got enough pivots. So I only mark the ones that have not been touched. But every once in a while, we get a situation like this. One, this is a point of control. It's 55.32-ish. It's close enough. This is a point of control area. Two, it happened right at the open in a Globex situation. Every analyst always has these little situations that they have to come up with an answer for. And you could do it either way. You could be a stickler for the rules and say, nope, it's been touched. It's no longer a VPOC. I'm done with it, and not mark it. On the other side of that, you can look at it and have, your exceptions to the rules. Since it's a cog line and it's yesterday's point of control, and it was touched right at the open as it basically just fell down from that zone. If there hadn't have been such a strong market on close order, then we wouldn't have had this gyration like we did. We wouldn't have been up there anyways, and it wouldn't have been touched. I changed the color on it just to remind me for today that this is not a VPOC, it's just a POC. And I'm going to go ahead and carry it forward for today, because if we rally back up, which is what I think we're going to do, and if we're headed to this 55.60 level, which is another VPOC, by the way, then we're going to negotiate this 55.32 cog line. And I want reminded that it's not just a cog line. It's actually yesterday's point of control. There's a reason that it was yesterday's point of control, by the way, because it is a cog line. Just keep in mind what a point of control is. It's where the greatest amount of volume happened. That's it. There's no reading into that or seeing between the lines or, trying to gauge my intentions here. It's yesterday's greatest traded level. It's where the most people traded. That's it. That's it. So if we get back to that level, the expectation is that there's going to be a little bit of buyer's remorse or trader's remorse, in whichever way, shape you want to look at it. And think about it from your own position. If you got in yesterday at 55.30 and you found that we're back there today at 55.30, what would you do with it? You'd probably trade again, right? You'd probably close out whatever it is that you were in. Why would we expect something different from anybody else? The market maker move just grew another 1%. Now, this is a time-based measurement, and as the day goes by, it's supposed to get smaller just because there's less time left in the day. So as we're seeing it grow, it's growing faster than the decrease of time. I don't even want to hurt your head with the math that it takes to figure that out. Just, we know the clock is ticking down, and we know that that thing is increasing faster than it's decreasing from time. It's Kind of like that math formula about two trains driving towards each other at different speeds. Yeah, I always hated that math question. You did, huh? Okay, well, you're a nerd more than I am. That's okay. 55.92 is a cog line to the upside, 54.71 to the downside. This is the range for the week. This expansion so far this morning hasn't even gone to the edge of the expected move. So as much as it may feel very bearish today, we haven't done anything yet. We haven't gone anywhere. And this is where they've been buying it up, right? All these buyers down here. So far, they've been defending 5,500 before price even got to the 5,500, right? They've been front running that level. Will they continue to do so? It's kind of the question. We are below the 10-day moving average. I don't necessarily see that as a bad thing. We can be reminded of all the times we got below the 10 for one single day, and we rallied right back out of it every time. Now, it doesn't mean we're going to rally. There's no guarantee, right? One day doesn't mean anything. It just is a little bit of a reset. We're back to the center of the basketball court. The ball can go either direction. Looking at the 10-week, we're still in a very healthy condition, a very healthy space. We're not overbought in extreme situations. We're not all the way back to zero. We're sitting right where we would want to be. It's a good sweet spot. About 2.25 above the 10-week. Now, I was watching the money flow yesterday on the Visualize tab. This is where you can detach these things. Oh yeah, big move in the dollar and the 10-year, 2-year. It's picking up speed. At 8:20, by the way, more treasury markets open, so we might see a more exaggerated response. You can see it's starting to help a little bit, right? Starting to see a little bit of green in the ES and the NASDAQ as this move progresses. So it's not tick for tick, but the more weakness we see in these two products, the less weight we have on the S&P and the NASDAQ, and the more likely it is that they buoy back up. So the Visualize tab, you can choose what index you want. You can even put the Mag 7 in there if you want to. But a lot of times I just put, like the NASDAQ 100, the S&P 100. And when just the Mag 7 is running, carrying the rest of the market, what you'll often see is the advancing issues here have less numbers than the declining issues, but it'll have more capital. And that's what we had yesterday. We had a lot of capital headed to the upside, but we had most names declining. And that's a part of that disconnect. Until a month and a half ago or so, if the Mag 7 was running, we would expect that rising tide to lift all the other boats, and we'd have, a pretty diverse trading selection. We could pretty much just trade whatever you wanted, any industry, any sector, anything, because the Mag 7 was running and the whole market would buoy with it. That disconnect came when we had that NVIDIA move to the downside and the market disconnected. So it only went down 1%. NASDAQ hold the line while the NVIDIA move fell lower, lower, lower. Well, the disconnect is working in the other direction too. We had some really good moves in the Mag 7 yesterday, and yet we had a lot of declining names yesterday. So it's something to look for. If that Mag 7 is running and you're looking for that rising tide, you should see it in the advancing versus the declining issues. And that's all this is an advanced decline line. It's just more detailed because it gives you the volume and the amount of money. So you can see the money flowing in versus flowing out. And you can put whatever index you want. And you can load more than one. So you can stack these things on top of each other and put the S&P and the NASDAQ 100 and, just load it up with as many as you want. If we're going to see a flip and a run to the upside today, it could be done with just the Mag 7 carrying the rest of the market with it, but I would really rather see it happen on the back of everything, right? So that rising tide scenario. I'd want a high advanced decline line, 90 plus advancing with the money following it, no divergence in that. And I'd want it in the S&P and the NASDAQ. Doesn't mean we have to have it, but it would be a better rally. It'd be a stronger run. I broke Thinkorswim. We have to wait a second. It won't respond. There it goes. So things that are down the most, triple leveraged semiconductors, nat gas, home construction, home builders, regular semiconductors, not the leveraged one. The Mag 7 is down after being up over 11.25% in the last 5 days. Banks are down. Bitcoin. It'd almost be easier just to say what is not up, right? Or just say what's up. It's definitely all the Mag 7s and anything like it. So semiconductors, mega cap tech, things that are up. What's bonds? A reflexive bounce since bonds are down nearly 5% over the last 5 days. They're getting a little bit of a bounce now. Don't know how much I would trust that bounce. It's more likely a dead cat bounce than anything else. The VIX is up slightly, and so is the VIX on the NASDAQ. Got to say, there's some really nice moves in crude. Just be careful with this. It's directly connected to events happening overseas and storms. And so all of that can change very fast, right? China still got this gap. We've seen a gap down and then structure and then a gap down and then structure and then a gap again. So very cautious with this. We're not looking for any sort of run back. And I'm still targeting the year-to-date VWAP. To me, it has a date with destiny. That's what I'm looking for. So I see some fundamental change and we haven't got it yet. Mentioned bonds were down. It's been like a waterfall. This is more of a reflexive bounce than anything else. I'd mark the half back of this and see if it can even get past that. If it doesn't, that's probably a really good place to short, right? You'd rather add to the short on a reflexive bounce than add to a short or get into a short at the lows. You don't want to short from the hole. Solar is taking a beating. Usually ties in well with China being down. We have a double bottom setting up here. Maybe we can turn this around. Yay. So something like that for the double bottom. It didn't quite get to the 111. I would have liked it to get a little lower than that. And with the waterfall move here, still just kind of implies more of a dead cat bounce than anything else. It's like in this situation, which comes first? The dead cat bounce or the fact that it might be a potential double bottom? And I would say the dead cat bounce comes first because it's more immediate in time, right? You got to deal with the freshest data, and the freshest data implies that this is a dead cat bounce. So it shouldn't rise higher than this 41.25 area. It also implies China's not done in its move lower, right? Nat gas, waterfall to the downside. It's been a consistent, persistent move ever since the spot broke back below $3. Cloud computing, this is usually just a dot from the algos. We're not seeing real flows here yet, so I wouldn't get too caught up in that being down. Home construction, home builders, all of that, the entire space continuing to break farther away from this anchor to VWAP. We are getting to a structural low here around that $95 mark. If we break that, and this is a really ugly head and shoulders too, if we break this low, then we're going to focus on, you know, a nice move to the downside. I didn't get that lined up perfect, but it's pretty close. 94.25 is the line in the sand that really needs to hold. Just remember that skinny line discussion we had earlier. Just think of this as a zone. If you always picture a line like that, you're better off. If we can get under that, then there's the old phrase, you know, if 80, then 100. That counts the other way around too. If 100, then 80. So we just got to get through structure. Pot stocks continue their decline. That 786 level held as resistance. You can see the very poorly executed bear trap. Like we talked about earlier, it came back to the previous low. It extended lower, got to the 111, but it meandered around down here, building a bear pennant instead of giving us more of a V bottom reversal with a very responsive snap back that trapped bears. It didn't do that. So they really weren't trapped. They had plenty of time to get out, and well, you see the results. Now we're nearly right back down to the line again. Semis, we talked about them yesterday, needing to get above that half back, and it couldn't even do that. That was a nice recovery off of the lows yesterday, but now we've got demonstrated sellers across this high area and demonstrated buyers around this 225 low area. It's a wide range, 10 points. We could chop in there for a while, and it's not going to develop compression since it's so wide. Let's let it tighten up some. Bitcoin tested the low of yesterday. So far, it's holding around 22. This thing is really weak underneath its levels structure. Nothing looking good at this point. Could give some moves for Riot, Mara, Coin, Hut, Hive, all of that. And there was a notification that came through yesterday that Robinhood was hitting on down detector. I didn't go look, but might want to distinguish Hood a little bit to the side when you're looking at your correlated groups. If you're going to trade the Bitcoin proxies to the downside, put HUT in its own box maybe for the day. A lot of violence in GLD, but we're still getting these lower highs, and well, we're getting some equal lows. This might build some structure here, but the lower highs are still dominant. So this is, have caution. Watch the clock. Keep your eye on the news. Let Powell get done. We don't have any auctions today. So once we're done with Powell, we should be done for the day. Shouldn't be anything else of note that that can come in. So be careful, be safe. Watch for the correlated markets. I'll see y'all tomorrow.